Hey guys, we got to talk about PayPal. I was really looking forward to making this video because I thought that the headlines and some of the analyst research reports that came out after Q4 earnings were really misleading. Like they did a poor job of understanding what the cause and effect of the drop was. Was it a competition issue? Is it a management issue? Is PayPal becoming this quote unquote dinosaur, a slow growth, low multiple company? Are they in the institutional penalty box because they had whiffed guidance twice? Well, stay tuned because I will get into all of that and share with you my thoughts on the real reason they tanked and how you should be thinking about it if you're an existing investor or thinking about entering a position. For those of you who are new to the channel, I go by tenbagger. I'm a professional investor by day, and I've personally made over $1 million in the market through boring buy and hold investing. Some of you are probably wondering how I've managed during this period of heightened volatility. Like, can this dude be trusted? And well, I'll just let this chart over here do the talking. There's a reason why I'm 2x the Dow and 7x the NASDAQ over the past year, because I go deep into these companies that I hold and I help ordinary investors like you beat the market. All right, but before we get into the juicy details, I have an important and disappointing confession to make. I got this one wrong, and I'm pretty annoyed because I usually don't get positions of this size wrong, but I did on this one. And for my viewers who had invested alongside me, I send my deepest apologies and hope that you find some solace in the fact that when I pound the table for a company and get it wrong, I lose a lot of money too. So it's not a happy instance for either of us. But I figured the least that I could do is own up to it and give you guys an updated recommendation based on the numbers that they have put out and try to uncover the truth behind the situation. In that video, I had also talked about the drivers of the weaker than expected print that the market was looking for, how concerned I am about the competition that certain analysts had flagged, what I was expecting going forward, and what would make me concerned, such as a continued drop in the take rate. Okay, let's start with the results. TPV, or total payment volume, hit 1.25 trillion for the year, representing 36 and 38% growth, whether you look at it on a standalone or constant currency basis. Revenue was up 29% year over year growth without the impact of the eBay drag, which is really quite impressive. There was a slight deceleration in net new actives, which was fine, somewhat expected given the exit of the pandemic and lockdowns, people want to get out more. But crucially, that 9.8 NNA numbers does not include 4.5 million fake accounts. Wow, that is a ton of fakes, hot damn. But it also includes 3.2 million accounts from the Paytm acquisition. So net, we're definitely seeing a deceleration in legitimate net new account adds. If we compare that against the prior quarter, it's not actually that bad because we're assuming that there were other bad actors in those quarters. Customer engagement continues to grow by 11%, showing no signs of slowing down even as user growth tended to plateau. All in all, a really solid print to cap off the holiday quarter. However, we know that markets are forward-looking and 2021 was in the past. What they're really concerned about is that guidance. So let's talk about the guidance. And oh boy, it was bad. The biggest negative driver was the NNA figure. See, going into 2022, analysts had expected anywhere between 55 to 60 million net new accounts based on management's prior guidance that they would get to 750 active users by 2025. And now all of a sudden they've done an about face and they're saying that they're only going to get to 15 to 20 million, which is about 40% or less than 40% of what they had promised. And if you recall, just a few weeks ago, there was another company, a big company that started with an N, that whiffed their new account guidance by more than 50%. And guess what happens to their stock price? So if you combine that with the fact that the guide now called for revenue in the ballpark of 6% year-over-year growth in the first quarter of 2022, how can you not expect your stock to tank? Now, if that's all you gave me to work off of, it looks really bad, right? I would have told you to sell. But because you're on my channel where we dig really deep, let's break down and see whether it's really warranted. We're going to talk about a slew of factors to consider before making an investment, such as the results by themselves, the broader e-commerce landscape, competition, valuation, and finally, a recommendation. It sounded like a really terrible print, but if we dig into the conference call, we noticed that going into Q1 of 2022, there are a ton of headwinds that were actually tailwinds in 2021. First of all, we lapped a very strong Q1 that was boosted by stimulus, E-commerce at the time was still very strong thanks to resurgent COVID and lockdowns, limited availability of vaccines. So if people want to shop, a lot of them had to do e-commerce. There were a lot of stimulus checks going around. There's no talk of inflation. And this is the most important one. There weren't major supply chain snags that we have today. And the cherry on top is there's this new IRS rule that requires users to report business transactions greater than $600. That took effect January 1st, 2022. Users in 2021 did not have to contend with any of these. And then we have to strip out the fact that eBay is still a negative drag on these results. That 6% is inclusive of the eBay drag. If we take it out, it's probably closer to 8 or 9% if I had to guess. So that's actually pretty decent, all things considered, but the market was not having it. Absolutely destroyed PayPal after hours. And following that, we heard analysts and reporters give all sorts of varied and colorful commentary. Jim Cramer, shock, anger, complete loss of faith in management. PayPal is a dinosaur. PayPal is getting disrupted. Death by 1,000 cuts. Whoa. That sounds really bad, but let's take a step back here. If we look at PayPal's biggest competitors, Square, Shopify, we notice a very similar trend. Square is incidentally actually down more than PayPal. Now, what about Shopify, which was supposed to disrupt PayPal according to a prominent Bernstein research analyst? Well, according to their Q3 results, they're actually down from Q2 to Q3 sequentially. PayPal's numbers were softer than expected. Yeah, but guess what? Square's were even worse. Check out that gross margin deceleration here. Shopify had issued slower growth as well. So if PayPal was truly getting disrupted, we wouldn't see this. We would see winners and losers, just like Snap beating and Meta missing, and we just aren't seeing that here. If we take a step back and we add the e-com players to this list and other payments platforms such as Adyen, Lightspeed, Etsy, C Limited, Mercado Libre, we see a very similar pattern. And that is, as the economy opens up, people don't want to spend as much time on e-commerce anymore. And for those that do, they have to contend with these increased shipping costs, inflationary pressures, and all sorts of effed up supply chains. They have to order way in advance for the item to maybe get there in time for the holiday season. So what you have is this perfect storm of e-commerce and consumer headwinds, as well as a tightening Fed backdrop that just wholesale massacred growth stocks, but especially in the e-com sector. My point is, this does not seem like a PayPal problem. We need to fundamentally shift the narrative of how we view the company's performance. I mean, is PayPal's management free from blame? Absolutely not. They had no business whatsoever guiding so aggressively on NNAs. They probably should have realized earlier in the pandemic that the pandemic bump was just that, a temporary lift rather than a setting of a new normal. That's definitely on them. But guidance is one thing. It's a mistake. It sends the wrong signal to the market, but it doesn't fundamentally change the product, the competitive positioning. It doesn't change anything about the business. It's just a short-term forecasting tool for short-term investors. Now, I've studied the earnings of every single major company in corporate America, and we learned 4 major things. One is that supply chain and inflation are putting a damper on a lot of companies, including the very best ones. The second is that enterprise companies that sell products unrelated to these supply chain impacts are generally posting higher and wider beats than consumer companies. The third is that user acquisition is hard. We saw this with Netflix, we saw this with Meta, we saw it with Spotify. Most of these companies had guided more aggressive user numbers. Most consumer companies are in fact missing user acquisition targets. And the fourth and perhaps most important point is that e-com is not hot. I mean, we saw most players, not named Amazon or eBay's market cap, just evaporate over the past 3 months. And on Amazon's earnings calls, we learned that despite the increasing cost of Prime membership, which by the way is $20, close to 20% for some 100 million plus households. Despite that kind of pricing increase, and despite posting excellent results on AWS, taking share from Google, taking share from Microsoft, the midpoint of their guidance, revenue guidance for Q1 is still about 5 billion short, or 4% short of analyst expectations. And that is precisely because the core e-commerce segment is weaker. Taken together, these results could not be any more clear. E-commerce and the purchasing power of the unstimulated American consumer are both going down year over year this quarter. Management doesn't need to be replaced. PayPal isn't dying. It can certainly avoid the fate of becoming a maturing, slow growth, lower multiple company unless you believe that inflation will remain here forever and e-commerce is never coming back. Now, I'll admit this last piece is a little bit of speculation rather than rigorous analysis, but you know how Square had changed its name to Block back in early December? Well, it eerily reminds me of Facebook's decision to go Meta. Just a guess, but I suspect that they're reframing the narrative because the underlying results just weren't that great. And the more research that I do, the more convinced I am that these results have less and less to do with PayPal in isolation. Now let's talk about the other point. What if in the worst case scenario, PayPal somehow does become a slow growth company? That's what's causing a lot of the multiple compression that analysts and investors are fearing. Well, let's break it down. Visa has a 5-year CAGR between 2016 and 2021 of about 10% and trades at a PE in the low 30s. Mastercard is a little bit better. Their 5-year CAGR is about 12% across the same period, and they trade at 38 times. And here you have PayPal, predicted to grow at post-earnings 15 to 17%, trading at about 25 times. That is a huge discount to these legacy slow growth card players. And if e-commerce growth picks up again, those numbers will look even better. After all, management had stated that they were aggressive on user growth targets, but reiterated that revenue targets in the outer years, that is 2024 to 2025, are still intact relative to the guidance that they gave earlier in 2021. So why should a company that is growing potentially up to 20%, even 15%, trade at a lower multiple than one that has a history of growing at 10%? Just because they happen to be in at the flavor of the month? Or because travel demand is picking up so they get a short-term boost? As a long-term investor, this shouldn't matter. The bottom line is this: everything has a price. There are very few high-quality franchises that deliver the growth that PayPal does at the level of free cash flow to shareholders at this meager valuation. And it's not to say that PayPal can't do better in the base case. Venmo is growing by 50% year over year. It carries a higher fee rate than other areas of the platform, such that the take rate actually increased, breaking the trend of steadily decreasing take rates as the higher take rates from eBay's business tapered off. Last quarter, when I had made the previous video, I expressed quite a bit of concern if this number were to go down significantly, but that's not happening at all. In fact, the trend is reversing, and that is a huge positive sign. This quarter to me personally feels like a kitchen sink quarter. Everything that could go wrong pretty much went wrong in terms of public and investor and analyst perception. It honestly feels like investing in Wells Fargo back when it was trading at 25 or 23, second guessing every move, a deeply uncomfortable feeling when I was investing. But if you're a long-term investor, this is exactly the kind of feeling that you should be looking for. From a technical standpoint, PayPal is only $5 away from a very strong technical support level at around $120 per share. It's past the 3-day holding period and NASDAQ is trading below 14,000. I think the downside to the indices at this point is fairly limited. If we look back at history over the past 13 years or so, bear markets have usually ended before the NASDAQ composite broke the 40-month exponential moving average, which currently sits at around 12,000. Most of the time, it never got there. Maybe it got 75% of the way there, maybe it got 50% of the way there. So given that the underlying economy still remains strong, and the components of inflation, a lot of it's driven by high energy prices, supply chain issues, should naturally sort itself out within a year or so, with or without Fed intervention. And the fact that the indices, especially growth stocks, have taken a lot of carnage already. PayPal stock and just the share price has formed a perfect bell curve between 2019 and 2022, which means that it's actually a lot cheaper on a multiples basis, having built a 2-year base already. And I think if you're a long-term investor, this one's going to be a no-brainer. You could also consider diversifying your investment here by buying Square, C Limited, Mercado Libre, or other quality e-com players. The point is the same. These companies are at solid entry points and more a victim of the underlying macroeconomy. E-commerce might be out of favor now at the expense of legacy card payment processors, but don't expect that trend to stay that way forever. E-com was growing at double digits per year before the pandemic, had a 3 to 5 year pull forward during the pandemic, and is in a stronger position now absent supply chain issues and high inflation. For these reasons, I'm a strong advocate of buying the dip, or in this case, buying the utter train wreck. That's going to be all for this video. I hope you found it helpful or insightful. Please consider giving this video a thumbs up and subscribing. I'm not doing this for the money and clearly not for the fame, but it does tell me what kind of videos that you guys like to see, and I will use that input to make future videos. As always, thanks so much, take care, and hope to catch you on the next one. Peace out.